We will now spend some time on the at acquisition consolidation journal entry. The two entities, P and S, each have their separate financial statements and economic events. The economic event in P that led to the control over S was the investment in shares of S, being an asset. On the other hand, you have in the subsidiary separate financial statements, you have equity, which is equal to net assets, but included in the equity would be the share capital of the subsidiary, things like retained earnings or even revaluation surplus. What I want you to do now is, before you listen to the rest of the explanation, is just think about the at acquisition journal entry that you did in first year and try and explain in your own words the purpose behind the at acquisition journal entry. Because as I've said before, if you understand what you want to achieve with the at acquisition journal entry, it becomes easier to understand it and to remember it. Under the single economic entity principle, which is our main objective that we're working towards when we consolidate, all the totals and balances in the consolidated financial statements should represent transactions with third parties outside the group only. So that means that the effect of any transactions between the parent and the subsidiary inside the red block should be eliminated through the consolidation journal entries. Now, the common items or the intra-group items we're looking at here is first of all the investment in S that is recognized in the separate financial statements of P, and the common item to that in the separate financial statements of S is the equity of S. By P having an investment in S through which he gained control, P becomes an equity participant of S. So some of the equity of S is now attributable to the parent. If there's no non-controlling interest, which we assume for now, all of the equity of S is attributable to the parent because of the investment that the parent made in S. So that immediately becomes two common items that you have to eliminate in the group. The investment coming through from the separate financial statements of P and the at acquisition equity coming through from the separate financial statements of S. Because P and S are now seen as one single economic entity, you can also argue that you cannot have an investment in yourself as one single entity, and you also cannot have equity issued to yourself as one single economic entity. Furthermore, included in the equity of the subsidiary at acquisition date is typically something like retained earnings. Now, retained earnings is the accumulated profits of the subsidiary up to that date. That means that the accumulated profits included in the retained earnings of the subsidiary was accumulated by this subsidiary before the group was formed, before acquisition date. And for that reason, that retained earnings and equity of the subsidiary is not allowed to be in the group because it wasn't accumulated by the group. So that's another reason why that equity eliminates at acquisition date. From the accounting equation, you also know that the equity of a company equals its assets and liabilities. What also happened when P obtained this controlling investment in S? We refer to that as a business combination. And the business of S is represented by the assets and liabilities of S. So therefore, the assets and liabilities of the subsidiary at acquisition date is allowed to be in the group because that is what the parent gained control over through its controlling investment. So that does not get eliminated. The investment and the equity, that is the common items between the two entities in the group that you have to eliminate. But the assets and liabilities of the subsidiary is allowed to be in the group and will be part of the consolidated numbers. So we have now looked at the first objective of the at-acquisition journal entry, which was to eliminate the common items, the investment coming through from P and the equity of S at acquisition date. A second purpose of the at-acquisition journal entry is to recognize new items that originates in the consolidated financial statements at acquisition date that is not recognized in the separate financial statements of the parent and the subsidiary. What do you think those new items would be? The first item is non-controlling interests. Non-controlling interests are all the equity participants in the subsidiary's equity other than the parent. So it can happen, as we've discussed before, that the parent has control over the subsidiary but is not a 100% equity participant. Then those other equity participants are referred to as your non-controlling interests. They exist. They are entitled to a portion of the equity of the subsidiary. We have to acknowledge that they exist in the consolidated financial statements. So we have to recognize them and we have to measure them. So that is a second purpose of the at-acquisition journal entry, is to measure these non-controlling interests. What did we also pick up through the acquisition method? What else needs to happen at acquisition date? You also have to measure goodwill, or if it's not goodwill, your gain from bargain purchase. That is also items that's not recognized in the separate financial statements of P&S, but it's recognized into the group through the at-acquisition journal entry. Still looking at the at-acquisition consolidation journal entry, let's start talking debits and credits. From the previous discussion, we've now established the objective behind this at-acquisition consolidation journal entry and what we want to achieve through it. And that was, first of all, to eliminate the common items. And that was identified as the at-acquisition equity of S and the investment made by the parent in S. And to achieve that elimination, to achieve the elimination of an equity item which is normally measured and recognized as a credit, we need a debit entry. Now here I've indicated 3 items, and the reason I did that is to show to you that the equity of the subsidiary that eliminates is all the equity items of the subsidiary at acquisition date. You are familiar with the share capital of the subsidiary. You are familiar with eliminating the retained earnings of the subsidiary at acquisition date, but I specifically added another equity item which you haven't seen in chapter 1 to 3 last year, which is the revaluation surplus. And the reason I'm doing that is to show that it's all the equity of the subsidiary at acquisition date that eliminates against the investment. So the investment, which is an asset coming from the separate financial statements of P, will now be credited in this journal entry to eliminate. And here you can now clearly see what I meant earlier. With your consolidation journal entries, debits and credits often being in the opposite direction because it is adjusting journal entries. This would typically be your at acquisition consolidation journal entry, where there's no non-controlling interest. So that implies that the parent obtained 100% interest in the equity of the subsidiary, and together with that, the consideration that the parent was willing to pay for his investment, the value of the investment, would be equal to the proportionate share of the net assets of the subsidiary at acquisition date, which is represented through the total equity at acquisition date. Therefore, you can have a scenario where there is no non-controlling interest and also no goodwill or gain from bargain purchase, as we see in front of us. A further objective of the at acquisition consolidation journal entry is to recognize new items in the consolidated financial statements that's not recognized in your starting point, being the separate financial statements of P or S. And the first example is your non-controlling interest. Please note that I have mentioned before that your consolidation journal interest is primarily adjusting journal entries and not recognition journals. But in this instance, where I credit my non-controlling interest, this would be the recognition of non-controlling interest because it's created in the consolidated financial statements. Together with non-controlling interests, another item that I can recognize through this at acquisition consolidation journal entry is goodwill or gain from bargain purchase. When I have goodwill, there will be a new debit entry in the at acquisition consolidation journal entry to give effect to that. When there is a gain from bargain purchase that originates through the at acquisition consolidation journal entry, you'll have an additional credit entry to this journal. Remember, the new items that you recognize through this at acquisition journal entry is your non-controlling interest, goodwill, or gain from bargain purchase.